Hello friends, welcome to Pro Trading Zone. So today this is a special segment that I come up for a weekend, and this is specially talking about all the chart patterns that happened in Bank Nifty in the last week, that is from 25th of March to 31st of March. So basically one trading session of a week where an expiry is happening. So from Friday to Thursday, this is the days I am considering right now for understanding what was exactly happening in the market according to the chart patterns. If you would have only considered the chart patterns, what were the things that made sense and some of the important candles that happened. And basically I'm going to do it in a smaller time frame as well as in a little bit of bigger time frame, that is 15 minutes, but I will more focus on 3-minute time frame so that the curvatures or the things that happens in the market is more enhanced. 1 minute is far too fast for me, and I feel comfortable to take a trade or to understand what market is doing in 3-minute candles for an intraday trade. This is not for swing trading or positional trading. This is for intraday trade and exactly understanding what market is doing and how to take a trade even though you find a good chart pattern, and what are the important points when you should take a trade and when you should not take a trade in any of the chart pattern comes in place. So one important rule that you have to understand always is that you trade what you see on charts, not what you feel. This should be the mantra. You should only trade when you see something in the chart, not what you feel will what will happen in the chart or what you are feeling that chart will do. Only trade what you see in the chart. Yes, it is very important to know what are the chat patterns, and you have multiple videos on YouTube, and you will have multiple reference books that will explain you detail what exactly the chart pattern does. But for it to be very successful, it is necessary to understand that the setup which you are looking at, does it make sense to you or does it make any good effort to go on the direction that it is tending to. What I mean is that if it is showing a breakout to certain direction, is that pattern ready to give you an exponentially good move, or it is just gonna go up and fizzle out and come back down? So it will create a nuisance for you even though you are a option buyer or option seller. So today's chart pattern will help both an option buyer and option seller. And if you want to use this chart pattern for a stock analysis, for a purchasing for a long period of time, that is for more than 1 year, I would strictly suggest that you should use higher time frames. So the time frame for higher analysis of chart patterns is 1 hour. For a week's analysis, for a day's analysis, higher time frame is 15 minutes, not more than that. And for doing a trade or taking a trade immediately after you spot some chart pattern, it is necessary for you to look at a very small time frame, that is 5 minutes or 3 minutes. For me 3 minutes seems to be a very comfortable time frame for me while taking a trade. So right now we will see what were the chart patterns on the 25th that made us take a trade. So I will just give you a just briefing about zone trading. So what is zone trading? Zone trading basically deals with not taking a trade in a certain zone where you know that market can go up and down and be in a constricted area. That is, if you considered this and these two important pivot points for the day, you will see that market moved up and down but didn't move much. For a intraday trader who wants to take a trade and get out of the market immediately by booking some profit, only and only if you would have been a futures trader you would have made a good money over here. Later everything else would have created a nuisance for you and would have destroyed your trading psychology if you are not a veteran or haven't spent much time into it. So what we basically want to do over here is to make you enable about how to take a trade and when not to take a trade. So if you know what pivot points are and what is zone trading, you will understand why I do not take a trade when I see certain chart patterns forming within the zone. For today, that is on 25th, we could consider the zone that is 36,000, 35,638 till 35,216. Even though it is a range of approximately 400 points, I only prefer non-directional trading over here. I do not take a directional view for it, even though you could see some really good setups over here, but who knows that it is going to be made once market was here. No one knows what was going to happen if market is going to just push so high. If you see this big candle, you will know that it was going to go very up, but it ended up to be red and reverse bearish hammer candle, and it is very bearish. And immediately there was a green candle. There was nothing that showed that it was doing good. There was again a small bearish candle, and it still went up straight away. So to avoid this kind of false narrations towards the making decision, I avoid taking a trade in a zone. So this was zone trading. I am going to use that concept again and again to make you understand what exactly I mean. So if you want to understand which chart patterns to take a trade or make a big bet while taking a directional trading, there are two most important chart patterns that I consider. One is M pattern, and reverse of that is W pattern, and one is pendant pattern, this or symmetrical triangle which pointed towards the future. So future means in the time frame is this ways. So W and M is something that is formed in the market, and you have to consider a time frame of at least 2 hours, 1 hour to 2 hours before considering it to be a serious candidate, 1 hour to 2 hour before considering it to be a serious candidate to give you exponentially good returns on your single lot trade, or you can make a bigger lot trade. If you want to gain huge number of points, it has to create a M pattern or a W pattern on a 1 to 2 hours of time frame. That is, in a span of 1 to 2 hours you should be making this M. So at that point of time, this becomes a potent chart pattern that could give you exponential returns. So let's consider this to be an important pivot point for us to take a trade. If market comes down, creates a top, comes down again, and then goes up again after crossing this point on this line, then only you take a trade. It seems tempting to take a trade over here, but it could go exponentially down from here as well. So to avoid this kind of false trade, you only take a trade over here. And what is the upper limit? Upper limit is the day's high, or day's high plus half of the length that is formed over here from this pivot point to the day's high. This could be the potential return that you get. Similarly, for the M pattern, if it forms double top and comes to form a lower a lower pattern over here, you only take a trade over here, and the target is at least the day's low or day's low plus half of the distance from here to here. So this is how you take a M pattern trade. Pendant is a very common thing that happen and everyone knows is the market comes, it hits again, up and down, up and down, up and down, until and unless it comes to a very crucial point where it is just literally very flat, and then potentially it gives a trade towards upside or a trade towards downside, and that too very exponentially. So if you take a trade in this zone, you would be making good amount of money in a no time, but you have to understand in which direction it is taking. So generally we take a trade only after a certain pivot point is breached, that is at least few candles back. Pivot point needs to be considered as a important barrier or a pivot point, then only you take a trade. So this could be considered as an important pivot point on upper side, this could be on the lower side. If it breaches here and then comes down, you take a trade here. If it breaches and goes above here, you take a trade here. This is very important to consider in the aspect that you do not fall for a fake breakout, or if market just came down up till here and it just jumps up again, so all your trade would be false, and this line would be made in just one 5-minute candle, and you would be making a huge loss if you haven't put a good stop loss. So this is the basics that I consider to be very important for market to take a trade. So now let's see what happened on the day 25th. So here you can see there was a trend that was going on the downside, but if I would have been there, I wouldn't have taken a directional trade, because any point of time it could have breached above, and only if market takes a breach above this side, I would have taken a long trade, or market have breached below this side, I would have taken a short trade, or I would have bought some put. But if market is in this arena and doesn't breach this point, I wouldn't have taken any trade, because this was also one of the pivot points, that was 35,431. So if it would have breached over here, only and only trade that I would have taken for directional was this one, because it breached my important pivot point for that day, and I would have taken a trade. There would be a retracement over here again. I would have exited once one candle has formed over here, or it has crossed more than 30 points above this important pivot points. That was my exit. So my exit would be on this candle if something fails. For this chart pattern, this would have been my exit pattern. But for generalistically for you for a directional trader, this was the entry point. And if you see, there is one more pattern that is very important in the market, or is forming, is U pattern. This U-shaped pattern is very potentially high rewarding if you follow it properly. So whenever you find a area where the market has made a little bit of top, or has climbed up and then started coming down, but it is not falling very sharply, and it is creating a kind of a curvature in the downside. So this or the reverse one, or in this format, both are extremely powerful patterns, and it gives you exponential return once it breaches the important pivot point of recent high or low recent low of that point. So these things are very important. So this is generally not taught, but I find this to be very potent chart pattern for big returns. So if you see over here, it had triggered our chart pattern to for a buy, but only and only to come down. So you have to be very careful when you are a directional trader. And if it would have come down over here up till here and it forms a bearish pattern, reverse hammer, you would have definitely exited your trade if you find yourself good in chart patterns. But this things helps you understand that market will make an upper direction move once it crosses this point. So I would have taken a trade over here, but if I follow the zone trading and follow the important pivot points which I teach, I would have taken my trade over here once market have turned down, and then I would have got this kind of returns up till here. This would be my return, and I would have booked once red candle was shown. So this is for 25th. For 28th, on 28th, you can see the market was really on the sideways. So what I did was, whenever there is a double bottom forming or multiple bottoms forming, or there is a point where market comes again and takes a support, these 2 points, you draw a line and consider it to be important point. If market breaches this point, you will see that you will be having a good directional move, but if it doesn't, it respects it, you will find the market would be going up trajectorily. And here the important pivot points for us for the day was 35,000 74, 35,216, 35,431, and bottom 34,903. So if you consider this kind of patterns, there was a steady upward direction, but once it came down and took a support over here, it could be potentially a multi-bagger return on your buy side. That is, if you buy a trade for a very small amount, that is small premium on put side, or on, if market goes up, small amount of premium on call side, you would have made good return because market moved exponentially very high. So between this zone, we do not take a trade. If you consider the pivot points that I just told you, 35,216 and 35,074, I wouldn't have taken trade. I would have only taken trade if it would have breached this point to give me a good return, and to exit only and only if I see a red candle forming, or if I have faith that market would be going up and it is a good directional move. I would have exited again over here when my pivot point was touched again in a retracement trade. So this could be considered as a retracement trade, and market went up. So you can file multiple setups in a day, but it depends totally on you, on your discretion how you take it. This could be considered as an upward trend, but you would have been breaking your psychological uh, trading mindset that if market is coming down, I would be losing my money again and again. So you would be exiting, or you would be in a panic to exit, until unless you would have been a put seller over here. You wouldn't have considered this pattern to hold your position. If you were buyer, you wouldn't have considered to hold your position, but for a put seller, the market is going up and making a little bit of downside, it is okay because theta decay is in their side. So market went up. So for next day, the next day was 29th of March. You could see the market was approximately on the sideways in every fashion it could be, and it was just running around the point of 35,807. Even though there were some red shoots on the downside over here, it was coming down. We would have only taken a trade once our pivot point is breached. If you want to see what pivot points I take, you should follow my long videos on the daily time frame. It will give you a basic understanding what exactly the pivot points are for the day. I put in shorts every live session. I put in short in every live session and give explanation why I'm taking it, and basically make you understand what are the uh, zone trading that I am doing. So I wouldn't have taken any of the directional trade other than this one for the day. But one important chart pattern that was formed was this U pattern over here. Whenever I find a U pattern, I find it to be very comfortable to take trade over here. I would have taken my trade over here and ride it up till here. A red candle would have formed, I would have exited, or I would have hold until it turns down from 35,010, but I would have hold my position up till here. From 35,738 to 35,972, that is approximately 250 points of capture because of this U pattern forming over here and taking a trade, and it would have been high probability high profit trade with multi-baggers of return if you are doing it properly. So the next day was 30th March. So here you could see there was some channel that I would have considered while taking a trade if I would have been a directional trader. For me, being a non-directional trader or a zone trader, what I would have done, I would have placed my short straddle and strangle around here. That was 36,300, because 252 there is no point where you can take a short straddle there. A short straddle and short strangle, and wouldn't have traded until the market would have moved above 36,498 or below 36,070. So once I was considering to take a trade over here, I wouldn't have done any of my trades. I would have considered this channel to be downwards trending, but it was no point for me to take a trade because it was inside the zone. And once it is inside the zone, in a zone trading, you don't take a trade. Once you have taken a non-directional trade, you just sit on it. You let the market Greeks work, option Greeks works for you. So here one of the important thing that happened was that market has created a zone over here, or a price action where it didn't breach the first candle's low, or the low was touched twice by two different candles. So as I told you, a double bottom is a very important for me, and the market just went up. It gave me an understanding that market would be going up, even though there would have been some retracement over here, but it was a valid retracement because it was our pivot point that was making sense for us, that this is a reversal that could potentially be a reverse trade towards upside, even though there was three red candles over here. So this could be a reversal retracement trade towards bullish or going up. And once it created again double top over here, this was an important pivot point, so I just drew one of the line, horizontal line, and market went sideways. So this could have been very bad for a option buyer, but for an option seller who would have sold call option short, would have been making a good amount of money and wouldn't have been worried much, as market was coming down steadily and he would be eating the theta in the market. So this was an important thing that happened. There was no other potential trade. Even though you try to find out, you will only try to see was what was not present over there and only take a trade that will create a nuisance for you. So on the option expiry of the year's end, week's end and month end on the single day, there was extremely good chart patterns that was happening. That was the channel trading that was happening. We made a extremely good amount of money. You can just check the option expiry video of ours. We made a heck lot of money, and these were the channels that formed. So basically each time you could have sold your call position over here and you would have made good money in this short side, that is call short would have said you would have made money while going down due to theta, and as well as the delta would have helped to gain the points in the market. These were the important for the last option expiry. And one more thing would have been, if this channel is breached, this is going up, because whenever a channel is breached, it goes up, it is considered to be a valid downward channel upward breakout. Similarly here, this could have been considered as a pole and this to be downward wedge or a flag, and then market would have gone up, but it would have only created nuisance when it started going up. So option buyer would have been in problem. It is not that option buyer doesn't make money, but they are uh, considered to be very accurate when they are making profit in option buying for a very long period of time, that is 1 year 2 years time frame. Even the reward is high, but I still avoid option buying. So once it started coming down, you would have made money every time you would have shorted the call on the first. So this was the option expiry. This will be done. This was all about the last week's option expiry and the charts that happened. So in the last week, you can look what profit we made. You can follow me, subscribe my channel to look at what live shorts I put in. I give trades about market analysis, chart patterns, what is the trade I am taking, what are the important pivot points, why should I consider one of the chart pattern important or not in the live trading session before the chart is forming a good candle. I am telling you what exactly is happening. But you have to remember, you have to consider market as king, market as the superior one. Market tells you what it wants to tell you. You do not assume it. You consider market's decision as the superior. You take a trade. If you find yourself to be on the wrong side of the trade, you exit and you respect the market. And whenever market gives you profit, you keep it. So if you liked my analysis, I would sincerely request you to please subscribe, like, share with your friend. Visit my channel in the live trading session. I give live shots and analysis and the trades that I take into consideration. So this is for today. Thank you.